Swayam Prabha. Digital India. Educated India.
Okay, welcome to the next session on commodity derivatives and risk management, and we will continue with our discussion on crude oil risk management. I'm sure you recall this particular slide in which we had discussed about futures contract specification at crude oil futures contract specification at CME, futures contract specification at MCX. We also spent a couple of minutes understanding the data which was published, which was given by the Multi Commodity Exchange India when the market was open, and we also discussed about the hedging policies of Indian Airlines in the last session, and I also discussed about the survey finding of undertaken by Marketers Energy Advisor with respect to airline fuel hedging and risk management policies of global major commercial airline companies. Now today we will be discussing different kinds of risk management strategies which are in generally used by crude oil producers and crude oil refining companies. Now let's go to the today's agenda. Okay, I'll start this session by asking a question. Do you think the available inventory has some relationship with the contango and backwardation structure of a commodity? Okay, the answer to my question is, many times we have already discussed, whenever there is a abundant supply of a particular underlying commodity, that commodity tends to exhibit a contango market. And we have also discussed in case of a backwardation market, when underlying commodity has supply constraint or not available enough, then the market exhibits backwardation. So at this point of time, if you recall, this is the second graph which is there in front of you, that is WTI NYMEX crude oil futures contract, which traded on 22nd June 2016. If you can see, the near month contracts are lesser than the far month contracts. So this is a typical structure of a contango market, and the first picture which shows the US ending stock of crude oil, and this particular picture, this particular graph shows the availability of crude oil in I think 1,000 million barrels. It is a million barrels in as per the US IEA data, and I have converted into 1,000 million barrels. So if you can see, almost by June 2016, that is May 2016, it is at all-time high, and this picture shows up to January 2016, but actually it is gone up to May 2016. Now when we are juxtaposing both these pictures, so we can very well see that whenever there is a abundant supply of a particular underlying commodity market tends to exhibit contango. And with respect to this commodity availability in abundant and the commodity market exhibiting contango in USA, there are a lot of contango trade is happening. So what do we mean by contango trade? Let's go to the next slide to understand more about it. So the storage cost and contango trade is it's a they have a very clear relationship. So what exactly this relationship indicates, that if the cost of crude oil, buying crude oil today and storing this crude oil for, let's say, 6 to 12 months and paying the lease rental for these 6 to 12 months, and pay also whatever other attendant fee is required to store this oil for 6 to 12 months, and all this cost of fund, all this is less than the future price prevailing at this point of time, then many people would be interested to buy the crude oil or the underlying commodity in the spot market, lease it, go to a storage location, store this underlying commodity, and simultaneously enter into a short futures contract. So this is exactly what a contango trade is all about. So if you recall, in the earlier part of this lecture series, we did discuss about the difference between pricing and valuation of commodity forward contract, and in those sessions I did discuss about cash and carry, cost of carry model, and when the model deviates from the cost of carry relationship, you have cash and carry arbitrage or reverse cash and carry arbitrage. So this contango trade is nothing but a cash and carry arbitrage. So what exactly currently people are doing? So they are buying and selling the crude oil and storing it in storage locations. And in USA, as per the current information available, per barrel per month cost comes around 30 cents, and it has got maybe another 5 to 6 cents are required for pumping and insurance, etc. cost. So all these costs, buying and storing and all attendant cost, if it is less than the prevailing futures price, then people will be undertaking contango trade. So how exactly this will happen? Let's take a numerical example to understand. So let's say the spot crude price is, let's say, per barrel is 46.90, and suppose per month storage and miscellaneous cost comes to, let's say, 40 cents, and let's say if so what should be the theoretical forward price? That is F0T. If you recall this symbol, that is forward price prevailing today for a maturity T, would be S0 spot price plus present value of all costs plus into e to the power RT. Let's say T is equal to 6 months, or let's say continuously compounded rate in USA, we take it as 1.15% per annum. So if it is 6 months, so let's say the present value of all costs, so this storage and so present value of all other costs, let's say it's 1 point that is 1 point, let's say $95. So what should be our F0T? F0T should be 46.90 plus 1.95 into e to the power, that is 1.15% into 1 by 2. Let's say that comes to, let's say that is coming to our $50.75. Let's say, I don't know, I have not done the calculation. So let's say assume this is equal to this. Now if 6-month forward contract, 6-month futures contract is trading at a price which is, let's say, actual F0 6-month as per this contango graph, as so suppose let's say it is quoting at $51.90. Then this gives a very clear cut indication to us or any trader for them to buy crude oil and store and simultaneously enter into a short futures contract. So in fact, there is something very interesting happening at this point of time. There is so much of demand for storing crude oil, is that the crude oil in USA is that the storage cost is increasing. So with the increase in storage cost, so this benefit is not going to be available to a trader. So how this cost can be mitigated, if at all this cost can be mitigated? Of course, as and when if new storage tanks are being built, then the price leasing price may go down, but it takes time to construct new storage tanks and the pipeline and all that. So there is a time lag for it. So in the meantime, if the storage cost increases, so what a trader will be able to do it. So the moment there is any variability in a price, obviously we can have a forward or futures contract available for that. So you have a contract which is available for trading in at Chicago Mercantile Exchange, that stands for loop futures contract. So what exactly loop is a loop futures contract? It's the full form of loop is Louisiana Offshore Oil Port Crude Oil Storage Futures Contract. So if you can see the slide, this is, let me repeat, loop stands for Louisiana Offshore Oil Port Crude Oil Storage Futures Contract Specification. Now let's go to see what is the underlying for this particular futures contract. Let me make it a little bigger. So this is traded at CME. Again, I have downloaded this contract specification from the CME website. The link is available. And what is a contract unit? Contract unit is for 1000 barrels, but please note the buyer or seller, the seller of this particular contract is not going to deliver 1000 barrels of crude oil. Sorry, this is the contract specification, loop crude oil storage futures contract specification. This is again downloaded from CME. So please see, the contract unit is 1000 barrel, but 1000 barrel doesn't mean that the trader is going to deliver 1000 barrel. But what is the delivery? What is the underlying to be delivered? Please see the last row. The seller shall provide the buyer with capacity allocation contract, which allows for the legal right to store crude oil for a calendar month at Loop LLC storage facility in Louisiana. So by entering into this futures contract, the buyer will have the right to store 1000 barrels of crude oil. So now you have a contract which is available for mitigating crude oil price risk. You have a contract which is available for mitigating your storage rental risk, as well as I mean, if you have read in your financial derivative, there is a derivative contracts with respect to interest rate futures. So if you are anticipating that interest rate is going to go up, which specifically in the context of USA, we are almost every time whenever Mrs. Janet Yellen, who is the chairman of Federal Reserve Bank, she attends a meeting, the first and foremost question which is asked to her is that when the US interest rate is going to be hiked. So if US interest rate is hiked, then the profit from the contango trade will go down. So if somebody is interested to mitigate that risk, that trader can also enter into a futures contract on interest rate. So more about what is a loop what is a loop contract that is available in this link called loop fact card. So this will be available, I can upload this one for you, or it will also be available at the CME. If you just give a search and call loop fact card, you will be able to download. So if you are more interested to know how this contract is used to mitigate the risk, you can spend some time. Now remember in the last session I had discussed about the commodity forward curve with a very clear cut seasonality. So let me take you to that. Yes, this is a commodity forward curve I am talking about. If you can see, this is a beautiful curve, very sequentially at a specific time interval the curve has gone up and it has come down, and this is a clear cut example of a commodity forward curve which is influenced by the seasonality. And we did discuss in the last session that in the summer months the gasoline price or petrol price increases substantially, and during winter months it goes down. Now my question to all of you is that is only seasonality is the only factor for such a substantial difference in summer month and winter month prices, or is there anything other than that? Okay, the answer to my question is there is another interesting factor which makes the price difference in the summer months and winter months with respect to gasoline prices in USA significantly different. So what is that reason? Let's go to this particular PPT slide. So you have why I started this particular slide with this asking this question: why gasoline is more expensive summer months than the winter months? Of course, in USA in summer months many people travel, and so that is one of the reason why you have higher demand for gasoline during summer months. Also, another important and interesting factor is the quality of gasoline which is made available during summer months is of better quality, and people have to pay a higher price when they buy this kind of a quality petrol, and all filling stations are mandated to keep this better quality petrol in their filling station, so that any traveler or whoever is buying or filling in their cars, they will be filling in with a better quality petrol. In fact, as you can see, as per the 1995 reformulated gasoline program, which was established in the year 1990 Clean Energy Act, this act requires the better quality of gasoline to be available during summer months to reduce pollution and smog, and reduce its impact on carbon emission, reduce the impact of carbon emission on ozone layer. Now let's go to the Okay, now let's start discussing about how exactly different hedging instruments have been used by crude oil production company and refining companies to mitigate their price risk. It's a little old survey, nevertheless, both these surveys indicate how many companies are using what kind of instrument to mitigate the price risk. So if you can see swaps, both this survey indicates that commodity swaps, swaps contracts have been used by most of them, and followed by fixed price forward contracts. You have collars, you have futures, options, and volumetric production payments. So we have already discussed about futures and options quite a few times, so I'm not going to discuss much about it. So today I'm going to focus on swaps, fixed price contracts, collar, and volumetric production payments. So let's go to swap. So what exactly is a swap? Swap is nothing but a okay, let me first explain the fixed price contract and then we'll go to the swap. So what exactly is a fixed price contract? Fixed price contract is a forward contract, nothing nothing more or less to it other than what we have discussed with respect to forward contract. So it's a bilateral contract and delivery of crude oil or refined product. So buyers and seller enter into a contract. So delivery schedule, quality, premium, price, everything is decided upon, and both parties abide by this their side of the bargain, and the buyers pay money and sellers deliver the crude oil or refined product. So whatever may be the agreement. Now let's go to swaps. So what exactly is a swap? In a swap contract, you have two parties which exchange a series of cash flow based on a notional quantity of crude oil or refined product, and one party pays a fixed price and other party pays a floating price. And what do we mean by the word notional quantity? Notional quantity means the price is exchanged based on this particular quantity. So this quantity is this notional quantity does not mean that the seller is going to deliver crude oil or refined product for this for this quantity. This quantity is only used for calculating the payment and receipt. Now let's take some examples. So now I'll take some examples to understand more about how swaps work. But at this point of time, I would like to say that swaps are nothing but series of forward contracts. So let's take how exactly this swap will work. So you have a refiner, this particular example, a refiner who is buying crude oil. The refiner's fear is that crude oil price is going to go up if the refiner does not do anything. And it is expecting crude oil price is going to go up for some time to come, and it requires to, if it does not do anything, it will end up buying or paying higher prices for its crude oil purchase. So how it will mitigate this risk? By entering into a series of forward contracts or swaps. Let's take this example. So in this example, the refiner enters into the crude swap contract with a counterparty. And what is the duration of the contract? Duration of the contract is for 3 years. Notional volume is 10,000 barrel, and based on this notional volume of 10,000 barrel, both this refiner and the counterparty is going to be making payment or receipt on every 2 months. And what is the amount of fixed price which is negotiated upon? That is your $89. So let's take this example, how it will work. Let's say you have you have your refiner here. Refiner fears price to go up. that is crude price to go up. So what it will do, it will enter into a contract with, so refiner will be entering into a contract with a counterparty. So it could be any, so you have a refiner who is entering into a counterparty. So a refiner will pay fixed $89 and refiner will receive floating rate. So let's take this is the contract which is signed on today. So we are on 25th June 2016. So 2 months from now, 2 months from today, 2 months from today, let's see the WTI crude price is, let's say $72. So what will happen? So 2 months from now, a refiner will pay 89, will receive 72, which is the floating price. So net payment, you have a counterparty is here, so net payment is going to be, so net payment of $17 will be made by the refiner to the counterparty, and at the end of the 2 months, so $17 into 10,000, so 170,000 rupees, $170,000 will be paid by the refiner to the counterparty. And anyway, refiner is going to buy crude oil at $72 from the open market. However, he will be paying additional $70 in the to the counterparty. So his net payment is going to be 89 rupees. Let's take the other situation. Instead of 89, let's make it, instead of 72, let's make it, this price would be let's say $110. And the fear of the refiner comes to true. He was anticipating crude oil price to go up, and it has gone up to $110. So in that case, refiner will be buying crude oil no more at 72, 2 months from today. So he will be buying at 110, and in that case he will be paying 89 and he will be receiving 110. So it will not be net payment, it will be net receipt to the tune of $21. So the refiner is going to get a net receipt of $21. He will be buying crude oil from the spot market at a higher price, so $110 he will pay. Simultaneously, he will be receiving $21 from the counterparty and incurring a net payment of $89 for its crude oil purchase. So irrespective of what happens to the crude oil price during the coming 3 years, this party is going to pay on an average, this party is going to pay $89 for its crude oil purchase. So this kind, every 2 months, depending upon the prevailing spot price, WTI spot price, the payment, the party can be a net receiver of from the swap contract or net payer from the swap contract. Let's quickly, I'll give an example. So let's go to, this is a refiner, but what will happen to a crude oil producer? Crude oil producer fears crude oil price decline he is fearing crude oil price decline. So how he will mitigate that risk? So let me COP, I am shortening it, crude oil producer. He will be entering into a, let's say, a counterparty who is a bank, and in that case the crude oil producer A will pay floating rate and will receive fixed rate. So by receiving fixed rate, irrespective of whatever happening to the crude oil price, this crude oil producer is sure of getting the negotiated fixed price. Let's take an example quickly. Let's take fixed price is, let's say, $75. So let's take the example. Suppose floating rate increases to, so 2 months down the line, this floating rate is 105. Without this contract, this particular crude oil producer would be selling his crude oil produce at 105. So he will be receiving 75, he will be paying 105. So his net receipt is, so he will be paying $105, he will be receiving $75. So his net receipt is, or net payment in this case, net payment is $35. So he will be selling crude oil at a higher price, $105 per barrel, but he will be also making $35 payment to the bank. So his net receipt for every barrel of crude oil it will be selling, it will come to $75. Now let's take instead of 105, let's make this one to be some other price. Let's say we make it $60. So he will be paying $60, he will be receiving $70. So his net receipt is $15. So in that case, the company will be selling crude oil at 60. That is, his fear has come true. He was expecting the crude oil price to go down, and his fear has come true. He will be selling crude oil at $60, but he will be receiving $15 from the bank as part of the swap agreement, resulting in $75 of receipt for every barrel of crude oil. So this is a typical example of a swap contract which a crude oil producer or a refiner, a crude oil producer or a crude oil consumer will be taking. And if you recall, the refiner is paying fixed, so he is a buyer of the swap contract, and in this case the producer is paying floating, it is a seller of the swap contract. So with this we'll be winding up this session. We will be discussing about the other derivative contracts such as Kohler and volumetric production payment contracts in the next session, and looking forward to meeting you all during the next session. Thank you all of you.